Hello and welcome to Portfolio Matters weekly market checklist, week 109. And what a week it has been. It's all change. All the assumptions that we're making earlier in the year have been completely upended. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only. It should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research and consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this week?
Well, we've got a lot this week, Richard. The last Friday, when we were recording, Silicon Valley Bank was in difficulties. What we didn't know at the time was that venture capitalists were withdrawing their money at a record pace from Silicon Valley Bank to the tune of $42 billion last Friday, which by the close of the day left the bank insolvent. And that became the second largest banking failure in American history, and actually was not the only bank to go bust last week. Signature Bank, the third largest bank to go bust in US history, also went down. Silicon Valley Bank's UK arm was bought over the weekend by HSBC for £1, which guaranteed UK depositors. We then had contagion. So the failure of Silicon Valley Bank led to fears over Credit Suisse in Europe and to First Republic Bank and other regional banks in the US. We've now had shows of support for First Republic to the tune of $30 billion in deposits from 11 major US banks in a show of confidence.
More to the point, Keith, in a show of lack of confidence, but
well, it depends whether they've got a solvency problem or liquidity problem, Richard. So, it is.
They have solvency problems, Keith, because they've bought bonds that are not worth anything like that, what they paid for them. And they can't sell them in the market without going bust. So many banks, in my view, are now insolvent. Have been becoming insolvent as part of the Fed and all central bank interest raising process.
Yes,
and
well,
we'll be the last of it yet.
No, I agree. And we will show you some charts later about the losses in the US banking system. Okay, so how did the authorities respond? Well, the Fed reacted by guaranteeing 100% of the deposits of Silicon Valley Bank and Silvergate. Now, in the FT this morning, there is a story about how that has upset the ECB and other central banks around the world, because they had agreed on an international framework that would mean not guaranteeing depositors and allowing banks to fail. And then at the first sign of trouble, the Fed has essentially capitulated and guaranteed depositors. And reminder, Silicon Valley Bank, their depositors were not mom and pops in the US. They were big startups with lots, deposits in the millions of dollars, as opposed to, mum and dad with a few 100,000 or whatever. So
this is the conundrum the central banks face, and actually, of course, the ECB is being hypocritical as far as the Swiss Credit Suisse is concerned. I know that Switzerland isn't in the EU, and it will actually do exactly the same thing when its own banks start to go bust, because not to rescue them would result in a banking crisis. And this concept of bail-ins works for small banks where you don't care what happens to the depositors. But for a large bank where you do care what happens to the depositors, bail-ins simply don't work.
Well,
and it was pie in the sky.
I agree, Richard. But, we're talking about, in the case of Credit Suisse, a systemically important bank, globally important. In the case of Silicon Valley Bank, the depositors were all, startups with many millions of dollars. They could have taken a haircut of 10%.
Well, possibly so, but I think more to the point there is that those businesses would have gone bust because they would have lost access to cash.
Well, it depends how quickly you could pay out the deposits. I think they would have had 250,000, which admittedly for a company is not very much, but you could have paid out the value of the assets at market value, and very quickly you could have got to about 80%. The rest of the 20%, would have taken longer or may not have been there, but you could have, these startups would have had 80% of their money quite quickly.
Possibly so, but I think in reality the judgment was that the whole cohort of startup business would go bust, and that the loss of confidence in the US banking system would have been catastrophic if they hadn't stepped in. And the US, the ECB is not going to let European banks go bust. I know they let the Malta banks go bust. They didn't care about Malta, and anyway, they wanted to punish them for doing business with the Russians, but they won't let any significant banks in the European Union go bust. I'm sure of it, but that's my view.
No, I completely agree. Well, the other thing that the Fed did was it created the Bank Term Facility Lending Plan, which for 1 year will allow banks to borrow against their portfolio of US Treasury holdings at par. Now, this is important, and this actually increases liquidity because the reason that Silicon Valley Bank got into trouble was they had bought these bonds at, let's say, $100, i.e. face value, and they had fallen to, let's say, $50 in the market. Well, those bonds with a $50 market value and a $100 par value can now be used as collateral for a loan from the Fed to the value of $100. And what that essentially does is pump liquidity into the banking system, but also provides an unsecured loan from the Fed to the value of $50. $50 of that $100 is secured on the market value of the bond. $50 is not. That is unsecured, and that puts the Fed in entirely new territory because, reminder, according to Beige-Haut, when there's a banking crisis, the lender of last resort, the central bank, should lend freely against good quality collateral at a punitive rate. And the other thing about the bank term lending facility is that it lends at 10 basis points above overnight interest rates, which is not really much of a premium at all.
So this is actually QE4 to all intents and purposes. And of course, it won't end in 12 months' time. Whether it ever ends remains. I think whether it ever ends depends what happens to interest rates. And there's a sort of groundswell of opinion that interest rates now need to fall. My suspicion is that interest rates won't fall, and that what is in fact happening is going to fuel inflation as opposed to allowing inflation to be dampened down, because effectively they've restarted QE.
Interesting. Well, a lot depends on the what happens in credit markets, because you're right, they're putting liquidity back into the banking system. But if that doesn't get lent out, in fact, if credit conditions tighten, then it won't be inflationary. And all the indications are that credit conditions are tightening.
Yeah, because I'm agreed, Keith. And the corollary of tightening credit conditions is that interest rates are forced up if lending demand remains constant.
Well, that's it. Market interest rates are higher than the Fed rate.
Yeah.
And there were also international responses. So in the UK, the UK branch of SVB was sold for £1 with no state guarantees to HSBC. In Japan, the Bank of Japan bought equities to support the market in endless QE in Japan. And then we had an extraordinary week in the market. So equities sold off. But as you will see as we go through the charts, both the S&P and the NASDAQ ended up on the week after the Fed's intervention and pumping liquidity into the market. Really astonishing moves. The Nasdaq is up over 7% from its lows earlier in the week.
And that is because the market is anticipating interest rates falling and possibly a resumption of traditional QE, shall we call it?
Yeah. Yes, I agree. US regional banks sold off despite the deposit guarantee, etc. And they've bounced a bit, but they're still way down from where they were last Friday. And bond prices rose as the market has priced in lower peak rates and cuts in interest rates towards the end of the year. So there's been a huge move in interest rate expectations, leading to increased bond market volatility. And if you're interested, pause and have a read. But this week broke lots of records in the bond market. The biggest one-day fall in two-year Treasury yields since 1982, etc., etc. And on to other news. Well, Russia intentionally forced down a US drone over the Black Sea. So geopolitical tensions are not going away. That could lead to conflict between the US and Russia of some kind. The ECB held its nerve this week and raised interest rates by 50 basis points to 3.5%. Now, when we previously reported the ECB rate, we have reported the deposit rate rather than the headline rate. 3.5% is the headline rate. The deposit rate has been raised also by 50 basis points to 3%. And finally, Bolivia has become the latest emerging market to head into crisis. So the big story in Europe was it looked like that Credit Suisse was going bust during the week. And the FT provides some background. So Credit Suisse essentially is not profitable, and it's gone through serial crises. Last year, its assets under management fell by 27%, and bank deposits fell by 37% in Q4 alone. Now, this week, the Bank of Switzerland extended a $54 billion credit line to Credit Suisse. But that, as you'll see from some of the charts, that has not led to a bounce in either the bonds or the equities. And the market is concerned about the solvency of Credit Suisse and not its liquidity. Its liquidity remains good. So the Bank of Switzerland pumping Credit Suisse full of extra liquidity has not really calmed the fears. Rich, have you got any thoughts?
Yeah, one of the things that strikes me, Keith, and we've discussed this before. So we've had 10 years of ultra low, let's say 10 years from GFC, of ultra low interest rates, lots of QE. We've had vast quantities of derivatives issued during that. So the current total value, gross value of derivatives in the financial system around the world is about 600 trillion. My bet is that Credit Suisse is sitting 600 trillion. My bet is Credit Suisse is sitting on a chunk of those, and that many of them will be related to bond values, interest rates, and so forth. And they will have enormous losses on their balance sheet. And so will many other big financial institutions. And to bail that out is extraordinarily difficult, and they will try.
Absolutely. And I would say, Richard, that the lesson from the great financial crisis is don't go bottom fishing in banks. When the share price collapses, don't think, oh, these are fantastic values I've got to buy, because bank balance sheets are extraordinarily opaque and they will not tell you of losses until they absolutely have to.
And they net things off that actually might be net offable when everything is good, but when everything goes pear-shaped, you can't net them off. And suddenly your liability of zero becomes a liability of something with lots and lots of noughts after it.
Yeah. And then also we had the UK budget. So key highlights, the Office of Budget Responsibility is forecasting that UK inflation will fall to 2.9% by year end. Very
I
good.
think that's one of those charts that goes like this.
You're right, Richard. But it's from the OBR, who famously have forecast the UK budget so well. And they've also avoided that UK will avoid technical recession this year. Good news is the UK energy price guarantee has been extended until June. They've postponed the rise in fuel duty. The fiscal deficit forecast has been lowered. And the great news for me is the pension lifetime allowance has been scrapped, although Labour have promptly said when they get in, they're going to reinstate it. So,
but they won't, because the reason it's been scrapped is because all of the senior NHS doctors are going to leave. And if Labour reinstated it, they just go back to square one. So they won't. They're just saying they will because they haven't got anything better to say.
Well, they're saying that they'll reinstate it with an exemption of some kind for senior doctors. Okay, I'm not a senior doctor. So.
Well, there's time, Keith. You could start your training now. I'd let you prescribe me an aspirin.
Okay, now charts related to the news. And the first one I want to start off with is this. So every time the Fed funds rate rises sharply, you get some sort of financial crisis. And Richard and I have been warning about this constantly over the course of the last year, and it's arrived. Or some of the stress has been precipitated. You know that rising interest rates cause a lot of stress to the financial system, and somebody is going to be caught out. Now, the first person to be caught out is Silicon Valley Bank, but that does not mean it's the end. And given the rise in interest rates, that's a lot of financial stress. I expect other entities also to be caught out. Richard?
Yeah, I think Northern Rock and Lehman's come to mind. So Northern Rock was bailed out 8 months or something before the Lehman's crisis. Everybody thought it had gone away. And I think Silicon Valley Bank is just the harbinger. And obviously Credit Suisse is a huge problem. But I remember, I haven't got it on this week. We haven't got it on this week, I think. But a few months ago, we showed a chart of the balance sheet gearing of European banks.
Yeah.
And for big European banks, and for many of them, it's between 20 and 30 times. And that means they can sustain a loss on their gross assets of 2 or 3% before they are insolvent. And many of them will have sustained bigger losses than that on their portfolio of government bonds.
Yes.
Sorry.
Yeah. Well, fear is back. Actually, this is better than it was earlier in the week when we dipped into extreme fear. And those moves in interest rates have led to extreme bond market volatility as measured by the MOVE index. And reminder, US mortgage rates rise with bond market volatility because of the covered call component in writing US mortgages. We covered that in previous weekly. And further to our earlier conversation, these are US financial conditions, Richard. Kaboom.
Wow, that's a big move, isn't it, Keith?
Yeah, that is a huge move. Now, let's see what happens. You know, there's clearly some panic element in there. Will that improve or stabilize at these very low levels? Will US banks be cutting their lending?
Yes. Okay,
so this is Silicon Valley Bank, and, you know, talking about the dangers of bottom fishing. This last Friday, share price fell, was halted, and then by the end of the day, the bank was closed down by regulators. And you'll see, where if you look at the price relative to history, you might have thought here was a good time to buy. Never bottom fish in banks.
Yeah. The interesting thing here, Keith, and it's actually, if you look at the Credit Suisse graph, it's the same, only it's got that never-ending downward slope for the last 10 years, is that there are insiders who know what's going on.
Yes.
Well,
very good point. More on that in a bit. Yes.
And if you're not an insider.
Yeah. So huge failure, actually. The second largest failure in US banking history.
Extraordinary, yeah.
Yeah, and you look at this list of US bank failures, actually last week it was number 2 and number 3. And the failure of Silicon Valley Bank has caused a flight of deposits to the systemically important banks, where if you're a depositor, you are protected, whereas in tier 2 bank, if you're a depositor and it goes bust, you're an unsecured creditor. Now, in actual fact, when they go bust, you turn out to be a depositor. The Fed turns around and guarantees all deposits. Now, this is the US First Republic Bank, which also has large bond losses. And you'll see that despite all the actions of other banks lending it 30 billion and the Fed opening this lending facility, there was a surge in the share price yesterday, but by the close, it had come off again. So this is not over. The market is still concerned about US regional banks. And this is the regional bank ETF. You'll see it started the week last week at what, 64-ish, and then by the end it was down a third.
Well, basically, we've had debasement, and the next round of currency debasement is beginning, isn't it? So the US government can't afford the interest rates that it has to sell its treasuries at, and the outstanding treasuries have lost significantly in value, and the Fed is sort of some sort of bizarre type of yield curve control, whereby if you're a bank, the yield at which you can buy a treasury is lower than if you're a member of the public, effectively. And I suspect that's what they will continue to do. They'll have this facility in place whereby banks can buy at par. So banks can buy whatever, and then they will sell them back to the Fed, and the Fed will fund it because the demand for treasuries isn't going to be there.
Well, sorry, Richard, but I disagree with that. And that if you have a $50, if you have a bond which has a par value of 100 and it's worth $50 in the market, you can borrow from the Fed to the tune of 100, but you're borrowing that money at overnight interest rates plus 10 basis points. Now, for a bank, that is an expensive form of funding. Banks borrow short. So they borrow short from depositors at, if interest rates are 5%, they might give depositors 1 or 2 or actually 10 basis points. And so they're making a lot of money on that. When they're borrowing from the Fed, they're not making any money. And actually, they are trapped in having to repay the Fed.
So that is true, Keith. You're quite right. I agree. So correct. So I suspect that what may happen is that, well, this is the realms of speculation, isn't it? But the Fed in some way has to monetize the flow of US treasuries, and if the banks can't buy them, can't buy treasuries because the pricing is wrong, and they can't at the moment, then the Fed has to step in and buy them instead.
And having opened this lending facility, banks are using it at an enormous rate. So discount window. So this is usage by US banks of the discount window. And you can see it is more than during the great financial crisis. Absolutely extraordinary.
So 2020 was when the banking system was in danger of freezing up, wasn't it? And they launched that overnight repo, I believe.
Yeah.
And this is 3 times the size of that.
Yeah. This is a frightening chart, actually. That suggests there's a great deal of stress in the US banking system.
It suggests that they're not lending to each other. They're not lending to each other, doesn't it? That there's a lot of confidence. So
previously, the Fed was doing QT. Remember, during QE essentially buys bonds from the banks and from money market funds and gives them cash in return. When you do QT, you reverse the process. So you're taking cash out of the banking system and you're reducing financial liquidity. Now, the crisis of the last week has been because the banking system was short of liquidity. So essentially, the Fed can't continue with QT and continue taking liquidity out of the banking system when the banking system needs liquidity. So predictably, they reversed the process and QE is back. And you'll see that in essence, the Fed increased its balance sheet by 297 billion last week. So on Richard's point, QE is back. It may not be explicitly back, but in practice, it is.
They can call it what they like. If it walks like a duck and quacks like a duck, it's a duck.
So in context, here we are. We've attempted to do some QT, and that caused so much stress that had to reverse it very quickly. And that rise in liquidity was through extra reserves for the banking system, which is exactly what you would expect. Now, the failure of Silicon Valley Bank caused a run to safe havens and big drops in treasury yields. And in context, it's one of the fastest falls in 2-year yields in history. Take a look at this chart. And this chart is quite difficult to interpret, but very interesting. It goes through day by day over the course of the last week, the expectations for future Fed rate hikes. Now, in each case, the y-axis is hikes in 25 basis point units. So last week, on the 6th of March, you're expecting interest rates to keep on rising to July. And then we had the Fed Powell speech on the 7th, and you're expecting rates to rise faster and stay higher for longer. Then, the moment you had Silicon Valley Bank, you had a complete reversal, a massive change on Monday. You'll see.
Okay.
Go on.
So looking at these charts, what you can say is, what is the value of these charts? Because the market is just wrong. So if you go back a year, 18 months, what was the market predicting in terms of interest rates? Answer, nothing very much.
Yeah.
What were they predicting on Monday? Nothing terrible, well, more of the same. So the market doesn't understand. What this tells me is that the market doesn't actually understand what's going on deep in the guts of the financial system.
Yeah, no, as a predictor of actually where it's going to go, you're right. But as a symptom of the stresses in the market, then I think these are really revealing. Now, you're right.
They reveal a shock element, don't they?
They do. So that, for the look at the end of this year, they're forecasting 3 rate rises, and now they're forecasting 2 cuts. Now, and I think, at your point, the validity having changed by this much in a week, how much reliance can be placed on this? None. But, it shows you that there's a lot of fear out there in the market at the moment. And this week has been a very dramatic week, which was really the point of just showing this.
Yeah.
Okay, so on that point, these are the probabilities of what's going to happen next week. Now, reminder, the Fed meets next week to decide on interest rates rises. And this week, the ECB held its nerve and raised by 50 basis points. Now, the grey line is the probability that the Fed would rise by 50 basis points. You'll see that last week, that was the majority were thinking it would. Now, nobody thinks it will. The market is now split on a 1/4 point raise or no raise at all. Now, I very much hope that the Fed will raise by 25 basis points because inflation has not gone away. And market seems to have stabilized. The Nasdaq's up, the S&P 500 is up. So the Fed should be sticking to its mandate. So this is the yield curve. The whole yield curve has shifted dramatically downwards. And in the Eurozone, this was earlier in the week, again, big shift down. Now, so when we talk about what the Fed should do next week, this is what happened in 1998 when the Fed cut rates hard in response to the LTCM crisis. So in response to turmoil in the markets, that proved to be a huge mistake. And you hope that the Fed will be taking that into account next week and sticking to its inflation fighting mandate. Okay, on to Credit Suisse. Now, earlier in the week, the Saudi National Bank ruled out any further investment, and that caused accelerated sell-off in Credit Suisse, whose share price has been falling steadily as investors have lost confidence in the bank.
So interesting. There's an interesting correlation here, Keith. You can see that KBW Banks Index is highly correlated to Credit Suisse between 2018 and 2021. And it's lost that correlation now. What happens if it recorrelates?
That's true, but it says to me that the market has lost confidence in Credit Suisse.
It does, and what I'm saying is, I wonder whether KBW is actually going to go down where Credit Suisse is.
Yeah.
Because my view, as listeners, viewers will ascertain by now, is that this is not isolated to Credit Suisse.
The thing is, yesterday, after the Swiss National Bank intervened to lend Credit Suisse, was it $50 billion? Well, the credit default swaps kept on rising. And so the market is worried about the solvency of Credit Suisse, not its liquidity.
It's quite interesting. So apparently Credit Suisse senior managers spent yesterday phoning around their customers, telling them that everything was okay. Now, if I got a phone call from my bank manager telling me everything's okay, please don't withdraw your funds, I'd be thinking, God, I've got to get out of this one pretty quickly.
Well, honestly, Richard, I completely agree with you. Because the thing is, the article in the FT yesterday talking about how it lost 27% of its deposits in Q4.
Oh, yeah.
You think that's it. It's done.
Yeah.
That all this turmoil, you just move all your money to UBS. What's the downside?
Yeah, completely agree.
So, having rallied briefly yesterday, by the close, they were drifting off again. We just have to wait and see. It's impossible to know what's going to happen, but the auguries are not good for Credit Suisse. And this is the wealth management business, which is one of the crown jewels of Credit Suisse. And you'll see its clients are taking their money out.
Well, they're 5% down today, Keith. I've just looked.
Really? It's Credit Suisse share price.
I like that cartoon.
I like this one. So, as a result of all that, credit spreads in the wider economy are widening. So these are the rates on mortgage-backed securities versus the treasury rate. And this is the TED spread. Now, the TED spread is the difference between LIBOR, so the rates at which banks lend to each other, versus the treasury rate. And you'll see, actually, not too bad. It's ticked up, but not by very much. So the market is currently not that worried about general credit conditions. However, if we look at the FRA minus OIS spread, so FRA reflects the interest rates demanded by banks. The OIS spread reflects the risk-free interest rates. You'll see that has absolutely shot up. So the banks are worried about lending to each other.
And hence the size of the Fed's overnight facility.
Yes, absolutely. Okay, and in other news, this is Bolivia. So currently in default are Lebanon, Russia, Sri Lanka, Suriname, Ghana, and Zambia. Bolivia looks like it's going to be joining them. Okay, so finally on to this week's economic data, much less this week than last week, so I'm going to go through most of it. Okay, so we had the National Institute of Economic and Social Research monthly GDP tracker, and it reckons that in February, UK GDP fell by 0.1%, which was slightly better than expectations. The unemployment rate in the UK came in below expectations, flat at 3.7%. The labour market in the UK is still tight. In February, the claimant count fell by a further 11,000, and that was slightly worse than expectations. So fewer people have come off unemployment in the last month. Is that a sign that the labour market is weakening slightly? Weekly earnings, unfortunately, in January came in hot. So came in at 5.7% versus expectations of 5.6%. Wage inflation is proving persistent. The HMRC headcount for February came in at 98,000, beating expectations and well up on January. So a lot of jobs being created in the UK. In China, house prices fell again in February and missed expectations. Okay, now in the US, last Friday, we had non-farm payrolls and they came in hot yet again. February, there are 311,000 jobs created in the US, above expectations, but down on January. Now, the unemployment rate actually ticked up to 3.6% despite all that job creation, because the participation rate beat expectations. People are coming back into the labor force, and that is good news. Hourly earnings were also good news in that month on month, they rose only 0.2%, below expectations. Year on year, they rose compared with January, but were lower than expectations at 4.6%. Then earlier this week, we had US CPI. Most of it hit expectations. The only bit that was worrying was core CPI month on month, which beat expectations. Everything else was in line, but CPI is still high. It's falling. So in February, it was 6%, down from January when it was 6.4%, but still way above target. Now, the other piece of reassuring inflation news this week was PPI, and that was much better than expected. So it's expected at 5.7% year on year, came in at 4.6%, and month on month it was down 0.1%. So PPI leads CPI. PPI is the prices that producers have to pay, and that is falling, and so that should feed through to lower CPI in the future. And that is actually the first piece of good news we've had on inflation in a while, but it's a small piece of good news. Retail sales in the US were disappointing month on month, falling 0.4% in January after that extraordinary January number. And then we had two manufacturing indices, both of which were very bad. So consensus expectations, the Empire State was -7, came in at -24.6. The Philadelphia Fed Manufacturing Index was expected -12. It came in at -23. So no evidence of a bounce in manufacturing. Where there was a bounce, and a big and totally unexpected bounce, was in US housing construction in February. So month on month, it rose by 9.8%. Building permits rose by 14%. Completely out of the blue, completely against housing affordability, etc., etc. The US home building construction market is showing extraordinary resilience. Richard, some charts.
Thanks, Keith. So we've got UK payrolled employees, and there's a flash estimate there which shows that employment in the UK is still going up. The year-on-year change in employee growth, so we're at about 2 and a little bit %, and so it's still a healthy, from the point of view of economic growth, it's a healthy growth rate. From the point of view of controlling inflation, it's not that healthy. They have the UK unemployment rate, which is stubbornly refusing to go up, and basically the government needs it to go up in order that inflation starts to come down.
Well, actually, Richard, we're forecasting. The Office of Budget Responsibility is forecasting that inflation is going to come down to 2.9% by the end of the year and not a recession. So they're saying the inflationary pressures are receding and we don't need a recession to get inflation back under control.
Yeah, they are. I mean, there's some fuel price increases going to drop out of the figures, aren't they? And are probably, presumably, in the process of dropping out as we speak because of the huge spike in February last year. So that's obviously going to have an impact on the measured 12-month rate of inflation. The UK claimant count has fallen a little bit.
Yeah, the UK is actually proving to be remarkably resilient.
So the HMRC payroll count is showing a healthy increase in the February figure. And there we have US CPI year on year, which is definitely got a top in now, I would say. And the month on month CPI is, it's difficult to tell with this, isn't it? You know, it's bouncing around between 0.1 and 0.5.
Yeah, that's frankly, that's still too high for the Fed.
Yeah. And US core CPI looks very like the graph we saw prior to the last one.
Yeah, the only good news you can say is at least it came in on expectations rather than being above it, which has caused the last 2 months.
Yes. US PPI year on year is falling quite fast. I mean, the problem we have in the UK, of course, is we've got these public sector pay rises that are going to start feeding through, which makes you think the OBR might well be wrong. So in the US, all elements of PPI are falling quite quickly. So they're definitely on a clear downward path at the moment. And then we have the month-on-month figures for the US PPI.
Yeah, so it's actually negative last month.
Yeah. US retail sales year on year, chugging along actually at around about, I'd guess, 5% growth.
Yeah.
Month on month, this is there's a bit of fluctuation in there, but the general trend is that, as you would expect from year on year figures, that there's an increase.
Well, last month was poor. But frankly, it's going to be very interesting to see how the events of this week affect confidence, if at all.
Yeah, I think the problem with these month-on-month figures is that there is just natural fluctuation in them, isn't there?
Yeah.
And it's hard to know what the cause is over that short period of time. US non-farm payrolls, which had quite a chunky gain again in February.
Yep.
And the US unemployment rate is basically stable at about 3.8%. The labour force participation rate, as Keith said, is continuing to trend upwards, actually.
That is great news.
Yeah. And US hourly earnings on a month basis falling at the moment.
Yeah, that's reassuring.
And year on year, the trend is downwards, I would say. US manufacturing employment has fallen quite sharply in February.
Yeah. So we've been seeing all these negative leading indicators, and manufacturing employment, as we talked about, I think last week, has been holding up because of job hoarding. And are manufacturers finally capitulating and starting to lay off staff?
Yes, that's right. And there's the manufacturing index, which is basically still in this rather large sawtooth decline, which would be consistent with Keith suggesting that maybe manufacturers are capitulating. And the US Philadelphia manufacturing index showing the same thing. US construction employment just continuing upwards. And you just have to start wondering whether the thesis is wrong somewhere at some point, because it's not behaving according to plan, is it?
No, and you'll see in a second that house builders actually started work on more new homes. Amazing.
Yeah. Average hours worked. I mean, the scale on this graph is really, really small.
It is, yeah.
So this is showing that the changes in different areas of employment, particularly, as Keith says, the construction area employment is continuing to grow.
So you see that information technology, all the tech companies are laying people off.
Yeah, okay. I read yesterday, I think Meta's laying off another 1,500 staff. Redbook retail sales year on year. I mean, we'd have to say basically we're back now pre-COVID growth rates.
Yeah.
And we'll have to see whether it falls below this point.
Well, that looks like a parabolic decline.
Doesn't look healthy, does it, Keith?
Mm.
There we have the 30-year mortgage rate, which is now stabilizing between 6 and 7%.
Well, this number is from Wednesday, and frankly, it could well be out of date. Just who knows what's happened, because bond volatility's risen, which would tend to send it up, but then bond rates, 30-year bond yields have collapsed, which will send it down. So it's going to be interesting to see what happens next week.
And the mortgage index is still extremely low, not showing any signs of coming off that bottom. As Keith says, building permits spiked up sharply.
Yeah, I mean, so nobody's buying anything. There's loads of new building under construction, and about to come onto a weakening market, and yet US builders have started loads of new homes. How does that work?
Yeah, it's a puzzle, isn't it, Keith? It is a genuine puzzle. So
yeah,
but clearly that sector of the economy is not yet slowing down. The building sector of the economy is not yet slowing down.
Yeah, that's true.
There we have US initial jobless claims, which is sort of like something or nothing, really. It's pretty much stable.
Well, we got excited last week because it spiked, but then it didn't.
Yeah, it's the trouble, isn't it? US continuing jobless claims on a weekly basis, very, very stable. China house prices, we'll have to wait and see whether that is bottoming or whether it's just a little fluctuation on its continuing downward trend.
Yeah.
So the US labour market is remaining strong. We've got an increased participation rate, falling earnings growth, and a bit of a fall in job creation. US inflation is remaining persistent, but the PPI prints we've had recently suggest that it's going to continue falling. So US manufacturing is still weak. US housing construction is, to our mind, unexplainably strong. The jobs market is resilient, and Chinese house prices continuing to fall. So the US economy is not yet showing apart from the banking system, it's not really showing much consequence for the interest rate rises.
That is a very good summary, Richard, because so this week we've had, the financial markets having conniptions, but actually the underlying economy is doing just fine. So the market having priced in loads of rate cuts, that is making a lot of assumptions about how turmoil in financial markets will feed through to the underlying economy. And if it doesn't feed through, then, markets are wrong and they will have to just reprice back up. Okay, on to errors and corrections. Now, last week, I showed this table. And then the secret fund manager, who is a member of the team but never shows his face, got in contact to say that these were all wrong and that the actual PE ratios were much lower on other sources like Bloomberg. But we then had a series of exchanges in which it became clear that they weren't necessarily wrong. It was a question of how you measured the PE ratio, and in particular, when you measured it, because Charlie Bilello, who had put together that tweet, seems to have systematically chosen companies which had very poor PE ratios and over a particular period. So if you look at Kraft Heinz, for instance, it reported losses last year, and therefore, how do you calculate the PE ratio? Because earnings were negative. So depending on whether you take the trailing PE over what period, or the forecast or current earnings, you can come up with pretty much any number you like. Pause, take a look. And this was another one, Walmart. Again, report losses for a period, then the P ratio goes completely bananas. So the bottom line is P ratios fall into the category of lies, damn lies, and statistics. You need to be very careful in using a P ratio to check what the time period they're measuring the earnings over is and what recounting regime they're using. Because a big source of the difference between Bloomberg and Y charts, where Charlie Bilello was getting his data from, is that Y charts were using generally accepted accounting practice numbers, and Bloomberg was using the self-reported numbers, which are always much higher. So beware. Before using P ratios, check the assumptions and don't use them as an investment tool unless you know the assumptions in them. Okay, and on to one chart. Now, reminder, we've covered this many times before, but that red rocket going through the top of the chart is private credit in China. And no country that has had private credit growth this rapid has ever not had a financial crisis. So if you look at the light blue line, which is the US, you'll see that the great financial crisis occurred when credit growth had been rapid, but nowhere near the extent of China's credit growth. So we continue to predict that China at some stage has to have an enormous financial crisis. On to inflation watch, Richard.
Thank you, Keith. I just had the one number through to update people on, which is the US figures. So the US CPI was 6% in February, which is down. Core CPI 5.5%, also down. And we have interest rates in the US currently 4.5 to 4.75%. Will they go up, or is the Fed going to start pausing? Is the question on the talking heads lips.
Well, like us.
No, not like us, Keith. I think we're a bit more thoughtful than the talking heads. I like to think so, anyway. And the EU refinancing, the EU rate was raised to 3.5%, and as Keith said earlier, the deposit rate raised to 3%. And we still have the transmission protection mechanism, which ensures that the southern peripheral states, countries, bond yields don't get out of kilter with all the other European bond yields, and otherwise known as market manipulation. But we still have a little bit of net QT. I don't know if that will last for that much longer.
Yeah, let's see what happens this week.
Yeah. So services inflation in the US, and you can see that service inflation is high and continuing to rise, although the rate of rise is slowing, whereas other inflation is falling, particularly food and energy. Sorry, particularly food and energy and goods.
Yes.
And the trimmed mean inflation shows that inflation is falling, but not very quickly. So we have all sorts of measures of inflation, and they all sort of have different mechanisms. And so the trimmed mean is falling very slightly, whereas the median CPI, as measured by the Cleveland Fed, is still rising. So
yeah,
inflation is not yet licked, I think, is the message to give.
Yeah, that's absolutely right, Richard. So, the market is saying, the Fed's going to raise rates by less and then cut them later in the year. There's no evidence to support that from the CPI numbers as yet. The market is taking a lot for granted.
I mean, the more Fed raises interest rates, the greater the danger to the financial system.
Yeah.
So this is suggesting that from the Atlanta Fed, that sticky prices, which in the blue line are the problem, whereas flexible prices So the sticky prices are the ones that are slower to rise, but then they slower to fall. They just respond more slowly, basically. But sticky prices at nearly 7% is not good news, because that's a chunk of the economy which is experiencing a persistent high rate of inflation. And it's stickiest in housing, which shows that shelter is still high and not really responding, whereas core sticky PPI excluding shelter has dropped quite substantially. So basically, they're saying if you analyze stickiness, then non-shelter sticky inflation is falling, but shelter sticky inflation isn't.
Thank you, Richard. Actually, you interpreted that chart better than I did.
It's not easy, is it, Keith?
Yeah.
By the time we've got these charts absolutely lit, then inflation will no longer be a problem. We'll have something else we've got to work out. Shelter keeps rising because of lags in the owner equivalent rent, which we've talked about for quite a long time, actually. So owner equivalent rent is continuing to rise because it's a lagging indicator, basically. And it seems to be behaving totally differently to CPI excluding shelter. But it is a lagging, it's not a good indicator. Yeah. If you're trying to manage inflation, it's not a sensible indicator to have in your measurements. And this is why, because in the real world, rents are falling, but shelter CPI is rising fast, continuing to rise.
Yeah.
So it's not of date. And again, this is showing that year-on-year rents are down significantly from their peak, and the trend is down. And this is just a more granular view of that same chart. Housing units under construction, well, blow me down. We thought that was going to go the other way, didn't we, Keith? We thought it was going to be pointing downwards by now, and it's not.
It's not. But I mean, the point here is that there's still a lot of apartments under construction, and these are apartments, so units of 5 houses or more, and rents are coming down. When these finally start coming onto the market, then presumably rents come under even more pressure.
I mean, is there a mini bubble being created?
Yeah, well, you've seen the building permits this month and construction starts. Yeah. Everyone wants to add to it. It's essentially what we're saying is house prices just haven't fallen enough, and at these house prices, home builders are thinking, "Oh, I can make a decent profit."
Yeah. So the vacancies have risen. Actually, vacancies have risen effectively 50% in the last 60, 18 months or so, which is quite a chunky rise, which suggests that there is continuing pressure on rents. And wage growth is continuing to be below inflation. And I saw a chart the other day which shows that US real earnings are continuing to fall. No wage price spiral, and it's almost like employees have given up, isn't it? I mean, there seemed to be quite a lot of news in the US with their big pay claims and so forth, but that seems to have drifted out of the news probably since Christmas, really. As we said earlier, labour force participation rate is beginning to head back towards pre-COVID rates. Again, that reduces wage inflation, more labour. And the US federal deficit is widening again, and it's pretty big.
Yeah, no, it's very big. You know, it's at its depths of the great financial crisis, and so the Fed is tightening financial conditions, while on the other hand, the US government is stimulating the economy.
So this is a chart of M2 year on year, which is the green line. It looks green to me, and that has just fallen below 0. And then CPI, and what this chart basically is saying that CPI lags M2, and therefore CPI would expect to continue to drop as M2 falls. Oh gosh, the average tooth fairy payout. I think it used to be a shilling when I was a child, maybe, or something like that. Maybe it was 6p, probably 6p.
50p, I remember.
50p. Halfpence 3 farthing.
I think you're showing your age now, mate.
17 groats, I remember, was the best I ever got. They don't call me Methuselah for nothing, Keith. So February figures show that, this is our inflation summary. February figures show that inflation in the US is persistent with services inflation, but actually non-sticky inflation is falling. And we know that the stickiest element of sticky inflation, housing, is not falling. And we know that's partly because it's the way it's measured. Credit conditions tightened dramatically over the past week with the SVB, etc. So that may serve to put a big damper on economic activity, and also, well, not also, as a result of bank lending suddenly contracting.
Yeah. So
then running into UK inflation. So what is core inflation? So the ONS defined core inflation as that inflation without volatile items of food and energy, which of course we all have to use and aren't optional. Whereas the Investors Chronicle has a definition of core inflation that is inflation on the core household expenditures that we all have to spend money on, and they are not optional. And that's how they weight their basket. And this seems a much more sensible way of measuring core inflation. It consists of essential items. So using this definition of core inflation in the UK is now 35%, which is extraordinary. And fake core is 5%. And I have to say, I completely agree with this methodology. So we're being lied to by the government. Well, that must be a first, Keith.
Yes.
So this implies clearly that the poorest have been incredibly badly hit by the recent rise in inflation, because their consumption basket is hugely weighted towards essentials. They don't have very much money for non-essentials. And yeah, I mean, it's a disgrace, isn't it? But we have known that inflation has not been what the ONS purports it to be. And we know these numbers are manipulated for PR purposes.
Well, the thing is, Richard, I'm going to push back on that, because we've had several discussions about inflation, and ultimately it comes down to these philosophical arguments. So when you define core inflation, if you're a statistician, you're aiming to find how are prices moving in the economy, excluding the most volatile items, which could push the number up and down on a monthly basis. But what you want to know is, what is the broad mass of prices in the economy doing? And the ONS figures aim to do that by excluding food and energy. Whereas what the Investors Chronicle is trying to do is say, on the items that you can't avoid spending, what is the inflation basket? What is inflation doing? And I would really question whether 41% on food is the appropriate weighting. That would seem very high to me.
Well, a couple of points, Keith. Yeah. If a statistician is endeavouring to do something and they've succeeded in doing whatever they're endeavouring to do, that's fine. But we need to understand what it is they've done and what relevance it has to the real world. That would be my comment on that. The second comment is, clearly, if the weightings will pertain to a very small slice, because it's fixed at those weightings. It will not, of the total population, not many will fit into it. And then you have to look at what the distribution of income is around that point, right, to determine how many people are effectively sort of within 5% or whatever of that figure. I completely take that point, yeah. But I mean, I think it's fair to say that inflation in, let's call it core inflation by the Investors Chronicle definition, is the inflation rate that affects people on lower incomes.
Yes.
As an economy and as a society, we should be very concerned about that.
No, I agree with that.
Yes, so this is saying that poorer households will have suffered a severe reduction in their standard of living over the past year. What we're not doing is we're not really identifying who the poor household is in terms of income levels here, are we?
No. We're just it's people who are spending 40% of their income on food.
Yes. And we don't really know who they are in terms of income distribution. And this is the ASDA income tracker for the average family's disposable income, suggesting that it fell by 9.6% over the past year. And that's a significant drop, but that is in line with the CPI measure that we have had. Energy bills have been the main cause of the reduction in standard of living, and you can see that here. And energy bills should be falling, shouldn't they, Keith? Or rather, sorry, the energy is now falling out of the inflation measure.
The government price cap means that energy bills shouldn't rise, and then in the summer they should fall.
So the ASDA income tracker is off its lows, which suggests that people have had pay rises.
Or inflation has moderated in, food and energy, which is true.
Yes. So depending on your point of view, where you lie in the income distribution, inflation on non-discretionary expenditure has been up by 35% year on year. And this will have squeezed the budget of the poorest hardest, which is not good.
Okay, thank you, Richard. On to Recession Watch. Now, to reiterate, this hiking cycle is very fast by historic standards. The only hiking cycle that's faster was in 1980 to 81, when, if you remember, inflation was vastly higher than it is now. It was approaching 20%. So it is not surprising that has created a lot of financial stress. And Silicon Valley Bank is the first domino to fall, but there's a lot of financial stress out there. And the yield curve is now forecasting a coming recession. This is the 2-year minus 10-year, and it's forecasting a 70% chance of recession. Frankly, this was from earlier in the week. And the whole yield curve is now inverted. So if you believe the bond market is a good predictor of recessions, well, the bond market is certain what's going to happen. And talking earlier about Richard's point about monetary transmission, well, monetary transmission occurs when existing loans, which were financed on very low interest rates, have to be refinanced onto higher interest rates now. And this year you have 92 billion of commercial real estate paper due to mature. We're also finally getting a fall in temporary jobs, and this is a very good indicator of coming declines in overall employment, because the easiest staff to get rid of are temps. Now, in previous weeks, we have been puzzled by the failure of credit conditions to tighten even while manufacturing PMIs were falling. So we know that manufacturers, companies aren't doing so well. How come the market was willing to lend to them on the same terms, even though you could tell that manufacturing earnings were deteriorating? Well, you see here, far right, credit conditions tightened fast last week. So that chart, manufacturing PMIs didn't rise to close the jaws. Credit spreads rose sharply. It's an inverted chart. And tightening credit spreads are going to be a problem because consumers have been increasing their borrowing. So consumer credit is the red line year on year, growing quite rapidly compared to pre-pandemic, and loan delinquency rates are rising already. And you look at credit card balances, we've seen in previous weeks how credit card financing rates are at an all-time high since records began in the early 80s, and the balances are now at a record. So consumers are going to be paying more financing costs on their existing debt. Now, if we turn to Europe, these charts show industrial production by sector and focus on the red line. That is energy intensive industries. So they have been affected by the energy crisis. They're just, the Eurozone economy has done okay because the other industries have actually done surprisingly well. Can that continue?
I find the mining and quarrying one interesting. I mean, mining and quarrying is also energy intensive. But given the shortage of materials for moving into the decarbonisation of the world, that is a worrying graph.
Yeah. Okay, so in summary, credit conditions are tightening. That is the story of this week. And we just don't know how that will affect the economy, whether those credit conditions will continue to tighten or whether they'll loosen again. So there's a huge amount of uncertainty at the moment. Okay, and now we have a special section on the big story of the week, which was Silicon Valley Bank. Now, we have covered this already in part, so I'm going to try and push through this. Okay, so background. Silicon Valley Bank was a Californian bank specializing in lending to startups. Now, startups generally find it difficult to open a bank account because they don't have any money, etc., etc. So Silicon Valley Bank specialized in lending to them, and lots of startups had their accounts with SVB. But startups have some idiosyncrasies. So they're generally cash rich. And during the pandemic, they all raised money on Wall Street through IPOs or from VCs, and they deposited that money with Silicon Valley Bank. But because they were cash rich, they didn't really need loans from Silicon Valley Bank. And also, because they're loss making, they're not really capable of supporting traditional bank loans, which require on profits or revenues to service them. So as a result, Silicon Valley Bank had a lot of deposits, but nowhere to lend the money to. So in order to generate some income, it put its money into long-dated US Treasuries. Now, if you remember, in 2020 and 2021, the yields on US Treasuries were absolutely ludicrously low. And viewer Dan Simons, thank you, Dan, contacted us to remind us that back in 2021, Richard and I were wondering who on earth was buying these bonds at such ludicrously low yields. And now we know. So that was the situation going into this year. But obviously, the Fed started to raise rates and the value of those bonds declined, and they declined very quickly. And Silicon Valley Bank lost around $1 billion mark to market on its bond portfolio for every 25 basis point rise in the Fed funds rate. And crucially, it did absolutely nothing about this. It didn't hedge, and it didn't sell them. So that meant that it had to try and basically sit on them until maturity. So it had these mark-to-market losses, but as long as it didn't sell them, it could just ride it out. But then, of course, last year, a very rich funding environment for startups. This year, poor funding environment. And so those startups started running down their deposits at Silicon Valley Bank, leaving Silicon Valley Bank short of cash. And so in order to raise cash, it had to sell some of its bond portfolio. So on Wednesday of last, it sold 21 billion of assets to meet withdrawals, and that precipitated a loss of 1.8 billion. It then tried to raise money to rebuild its equity, but in the documents it sent out to prospective investors, it had to show the size of its asset book, and investors could see that it was sitting on further massive unrealized losses. The share sale failed, and then startups began a coordinated run on the bank which was coordinated by the VC firms and Peter Thiel, famous startup investor, on Twitter. So on Friday, there's 42 billion, or 25% of total deposits, were withdrawn, leaving the bank technically insolvent. Fed stepped in. Okay, so quickly, Silicon Valley Bank was heavily dependent on net interest income. So 73% of its profits were from interest in 2022. Larger banks have wealth management, etc., etc. Silicon Valley Bank, very dependent on its interest, and hence it was investing in long-dated treasuries to raise its income yield, interest yield. Now, banks lose money when borrowers default, short-term interest rates rise more than long-term interest rates, causing their net interest margin to collapse or go negative. And finally, interest rates rise, causing the value of their bond holdings to fall. And it is the latter two that has got Silicon Valley into trouble. It is not their loan book. So here you see bottom right that this year there have been big withdrawals from the bank, and that caused them to have to sell their bond portfolio to raise cash. And the net interest margin was forecast to drop because of the flattening of the yield curve. You'll see that their asset sale resulted in a loss of 1.8 billion. But investors could see that there was further losses of around 6.3 billion not yet taken on the rest of the bond portfolio. So although the loss of 1.8 billion was not itself fatal, unrealized losses on the rest of the portfolio scared both investors and depositors away and precipitated the crisis. The Silicon Valley Bank seems to have been incredibly amateurishly run. I mean, we on this podcast were talking about the dangers of buying these bonds at these ludicrously low prices, and yet they did a huge bet on them and didn't hedge it. And then as the prices went against them, they didn't sell them. And this is their hedges, there weren't any. But then this was a bank run for the modern age. So there were these conference calls between VC firms, and they all just agreed to take their money out. And so there's a massive run on the bank, and it failed after 25% of its deposits disappeared in a day. And in this, the digital age, it seems that bank runs can happen incredibly quickly. And so a side effect of modern media may be greater financial instability. On Friday, 42 billion was withdrawn. Now, the FDIC insures depositors up to the first 250,000, but at the first sign of trouble, the Fed has capitulated and guaranteed all the deposits in Silicon Valley Bank and the other signature bank. Now, Silicon Valley Bank was uniquely vulnerable. You'll see on this chart, on the y-axis is the percentage of retail investors, i.e. mom and pop, who are depositing their money in the bank as a percentage of the total. And you see they were very heavily dependent on corporate and startups for their funding. And that is a flighty capital base. But their losses on the securities make them a huge outlier compared to other banks. So they appear to have been uniquely vulnerable. So they are far left. Their losses, unrealized losses on their treasury book, were equivalent to the entirety of their equity. But there's a lot of losses in the system. So if you look at unrealized losses across the whole of the US banking system, you're talking about 675 billion. So Richard's point, there's a lot of losses to be taken somewhere.
Indeed. And if the banks can hold these to maturity, then it's not a problem for them.
Yeah.
They can't. It is a problem for them.
Yes.
And the other point that I made earlier, which I think is valid, but it's very difficult to assess to what extent, is there are also derivative holdings that are very vulnerable to these big interest rate moves that we've had.
Yeah, but this erosion of the bank's equity also reduces its ability to make loans. And so you'd end up with a load of zombie banks just waiting for the existing loan book to mature so they could repay the Fed.
Yeah. And the same must be true of Europe, because banks in Europe have been buying government debt. There's a lot of government debt in European bank books. Yeah. So they're going to have exactly the same problem.
But actually, Richard made this point earlier. Some people knew, and it was the management, and they sold all their shares in the weeks prior to the collapse.
Presumably they'll find themselves in court one day.
They will protest their innocence, Richard. It was like
they didn't always know it was going to happen.
Exactly. It was the market's fault.
Yes.
Okay, so what were the knock-on effects? Well, these are regional banks and big crisis of confidence there. And as of this morning, the injections of liquidity, the Fed's interventions are pumping liquidity into the system. They've not led to a sustained recovery. So the market is still very worried. The market is worried about solvency, not liquidity. Silicon Valley Bank had a portfolio of $80 billion worth of mortgage-backed securities. And the Fed is now going to have to sell those to recoup its funds from the guaranteed depositors. And that should lead to falling MBS prices and rising mortgage rates. Now, small banks already have very low reserves. And so this credit crunch could well result in reduction in lending from the US banking system. But
just to chip in there, Keith, the other thing is, if a bank is highly leveraged, then it doesn't take very much to push it into a solvency crisis.
Yeah.
And I don't know how levered SVB was, but coming back to my point about European banks, they are much more highly leveraged than many of the US banks. And it won't take very much to push them into a solvency crisis.
Yeah, absolutely. And the trouble for investors is these things are so opaque. You will only know when they're in deep trouble and they can't hide the losses anymore. Oh, and Jim Cramer obviously was pushing Silicon Valley Bank in the weeks before it went bust.
I mean, yes, it's quite extraordinary, isn't it?
So they've launched
but if you just had to look at the share price graph to see that something was clearly amiss.
Yeah, that's true. But I mean, they've launched this inverse Cramer ETF. It's like, because he seems to be systematically wrong. Actually, there are people out there, Richard, who think they should be launching an inverse Portfolio Matters ETF as well.
Are there?
Yeah, we've had a good week. Well, I think we have. Okay, so in summary, Silicon Valley Bank was a unique situation. It was uniquely vulnerable, but there are massive losses sitting on the books of US banks of around $675 billion caused by rising interest rates and falling treasury prices. Now, in part, that will have been unwound this week because, of course, treasuries have risen, but there's still massive losses out there. Bottom line is, we've been predicting this for a while. Rapidly rising interest rates, and interest rates have risen at a rate only previously seen in the early 1980s. That causes huge financial stress on highly leveraged institutions. Some of them will have messed it up. Silicon Valley Bank is the first domino to fall. Other charts, Richard.
Thank you, Keith. So cost of insuring against US default has, not surprisingly, risen very sharply in the last few days. And it's now as high as it was back in 2013, so as high as it's been for the last 10 years.
Yeah. So one thing that's in the background, of course, is the debt ceiling. And
yeah, that's true.
Coming months, the market is worried about a US default. If that happened, total Armageddon.
Yeah. Chinese retail sales recovering, but are well below their pre-COVID trends. They've actually got a lot of recovery to do, 13% off their pre-COVID trend now. China is starting to invest in fixed assets again. You can see on the right-hand graph that they are investing well above trend, and they are trying to grow themselves out of a financial crisis.
Yeah.
By loosening credit conditions, which doesn't really work.
Well, actually, I'm reminded of our cover picture, was it 2 weeks ago, of these infrastructure in China, where they're investing vast amounts in infrastructure which doesn't yield cash returns.
Yeah.
And so how do you then service the debts?
Yeah. And it doesn't assist the economy to grow because it's a one-off and there's no contribution. China is increasing its infrastructure spend as well. So again, that's that same problem of they are trying to keep the what are they trying to keep going?
GDP growth.
Yeah.
But you see, real estate investment, it's down year on year. And when you see the next chart,
yeah,
just absolutely mind-blowing.
So the UK house price to income ratio, down a little blob at the bottom, is just below 6, 5.5 or something. China, it's 17, and showing no signs of falling. So it is unsustainable. If it's unsustainable at some point, it will not sustain.
Yeah, agreed. Okay, on to good news. And frankly, it's been a bit of a grim week in the market. So this is a bit of gratuitous consumption.
Where did you get that photograph of my bedroom from, Keith?
I didn't know you lived in the Paris Opera House, which seems like a very good place to stay. So they've converted a box at the Paris Opera House into a €37 a night Airbnb, just as a kind of publicity stunt. But if you can do it, that looks absolutely amazing.
It's a proviso. You have to have the curtains open so everybody can watch.
I think if that was me, they'd be paying for to close the curtains.
Close the curtains, yes.
And this is the lobby. That's not bad either.
That's okay, isn't it? Yeah.
So anyway.
Very nice.
So the Airbnb are doing this as a stunt to try and highlight, the historic buildings you can rent out. But, if you can get in there and get a couple of nights in the Paris Opera, well, it's fantastic. And on to equities, Richard.
Thank you. It was a very strange week for equities, wasn't it? Bouncing around all over the place. But it settled down with the FTSE down 3%. FTSE All Share down 3%. Stocks Europe down 1.5%, S&P up 1%, and the Nasdaq up 3%.
Amazing.
And of those, the only one that's really made a big impact in the year so far is the Nasdaq. The Hang Seng is pretty much unchanged for the year, and the TOPIX had a big decline. And Keith mentioned earlier that Bank of Japan stepped in to support the equity markets, as any good central bank does these days. Bitcoin had a very good week, up 30%, and is up nearly 60% year to date. I think on the basis of the expectation of more loose money to come. So we have this bad news has become good news scenario, where asset prices rise because they think central banks will have to print money in order to suspend disaster. The dollar didn't have a particularly good week, so it was down against both the pound and the euro, and the dollar index there down 1.2%, and the VIX down 2%, suggesting that it's basically responding to the rise in the S&P.
Yeah, the markets are absolutely amazing and fascinating at the moment. Yeah. So the UK down 3%, the Nasdaq up 3.3% on the week. And as we go through the checklist this week, you'll see that commodities, energy commodities, where the FTSE has a big weighting, have been murdered. But the lower interest rates led to a revival in tech. It's an amazing story. And I'm very impressed with Bitcoin, by the way. You know, it's actually proving to be a safe haven against all my prejudices.
Yeah, it is actually, isn't it?
Now, the other thing I'd say is I have been doing the, the VIX thing. So I bought it. So I sold the S&P 500 when it was below 20, and I closed it out last week. And I made, I think, 120 quid or something, because it's pound a point. So, that'll buy me one fish and chips these days.
It will, yeah. Maybe a pickled egg to go with it, Keith. So there's the S&P 500. Is the S&P going to go nowhere for 10 years? That's the real question, isn't it?
Yeah.
Here we have the sort of gyrations of the week.
Yeah, I can't believe it ended up on the week. Just absolutely amazing.
And the NASDAQ up 7% from the low on the 10th of March.
Yeah. I mean, one thing we know about this year is you buy the lows and you sell the highs.
I mean, they are casinos, aren't they? They're not a stock.
Yeah.
They are casinos. Now we have the VIX, which is falling back down below that line of heading back down towards 20.
Yeah, I can't believe VIX actually fell this week. We've had massive gyrations, and VIX is down.
Agreed. So S&P 500 company revenues forecast to keep rising, whereas earnings are falling. So, what do you value them on, revenue or earnings? Personally, I would value them on earnings, not revenue.
Yeah.
But I'm old-fashioned. And 2023 and 2024 earnings per share estimates have been falling, but the market is expecting strong earnings per share growth next year. Well, good luck with that.
Yeah.
And if you're into the anti-portfolio matters ETF, that is a buy signal, by the way. And that just shows that S&P earnings forecast to be falling since December.
Yeah. But so basically, they're forecasting that earnings will start rising pretty much from now. I think they're a bit delusional about that.
I think so. And here we have, we've shown so many graphs of US stocks looking expensive, and here's another one. And you have to look at this one for a little while, actually, but basically, we are nowhere near the normal peak to trough levels for bear markets.
Yeah. We're just, we're still in a bear market. It's just taking a long time.
Yeah. So Vornado, I've never heard of Vornado. It's one of the largest office developers in New York, and its market cap has done a Credit Suisse.
Yeah.
And although Credit Suisse is actually down 98% from its highest, I was looking at it yesterday. This is not down 98%, a mere probably 95%.
Yes.
Whatever.
I was interested in this because we have been talking about the impact of home working on the office market. Yeah. And here you go.
And how are they going to do when they have to refinance their oodles of debt at 5% instead of 1%?
Go bust.
They will. They'll try and put rents up. They won't be able to. And then they'll go bust.
Yeah.
And office REITs have spent 27 years going nowhere. Yeah. Not surprisingly.
Nope.
Cash flows into MMF surged as investors sought safety. Now, money market funds, of course, will put their money into banks or treasuries.
Yeah.
So they're seeking safety from banks by investing in banks and treasuries.
Yeah.
What could go wrong?
Well, you'd also say that this is a great contrarian indicator because then, Wednesday, Thursday, the market rallied hard.
So what they should do, Keith, if they've got spare cash, they should invest it in physical assets.
Yeah.
Let someone else take the cash risk.
Okay, thank you, Richard.
Sorry, Keith.
On to commodities, energy commodities, and it was a terrible week, frankly. So Brent was down 6.7%, WTI was down 8%, Dutch natural gas futures down further 2%, UK natural gas futures down a further 5%. Coal down 3.3%, even uranium fell down 2.5%. So great news for consumers, and inflation in energy prices are coming off. Now, in the US, we actually had a draw in inventories. So inventories fell by 1.9 million barrels. Earlier in the year, we were having inventory builds, so the market seemed to be in surplus. Is it moving back into deficit? And that should be bullish for oil prices. Reminder, oil prices fell by best part of 8% last week. And US oil production is stable, and the Baker Hughes rig count fell by 2. Okay, so this is Brent, and pretty much at lows for a year. And frankly, the downwards trend looks to be intact. The IEA raised its forecast for oil demand for 2023, and that implies deficits in Q3 and Q4. So if the IEA is right, that means stronger oil prices later in the year. And reminder, last week we talked about how the oil market does not respond to future oil shocks. It responds to current oil shocks. And so in which case this may not be in the price, and oil companies could do well later in the year. European natural gas futures, is that a bottom? They're down on the week. UK natural gas futures the same. US natural gas futures bottom. Coal continuing to fall. Uranium, is that starting to drift off? Okay, on to industrials, Richard.
Thank you, Keith. So not surprisingly, given the turmoil, it was generally a pretty bad week for industrials, with actually the only exception being iron ore up 2.3%, presumably predicated upon China putting increasing investment in infrastructure building. But year to date, I just think is quite interesting. Year to date, we've got some really big moves now. So aluminium, not very much change. Cobalt down 34%. Copper actually pretty much holding its own. And we know that there's an impending supply shortage in copper. Chromium, likewise, up 12% year to date. Lithium, the Chinese lithium, now down 40% year to date, although I believe there's a price difference between the Chinese price and the price that, say, you would pay if you're in the US. And I understand that the US price has not dropped as much. Neodymium and nickel both down 23% on the year, tin down 10%. Ferrovanadium up 12%, which is the same as iron ore. And as Keith pointed out last week, vanadium usage goes up and down with iron ore usage to a substantial extent because of its use in strengthening steel. And then we have zinc, which is pretty much unchanged. So there's aluminium, cobalt, copper.
Yeah, Dr. Copper is actually diagnosing a world economy that's doing all right.
Yeah, you're quite right, Keith. It is, and presumably demand for copper. This is a guess on my part. I don't know the numbers, but I would presume that demand for copper isn't actually falling because we are doing more electrification.
Yeah.
Chromium, iron ore, lithium. The bizarre-looking chart.
Yeah, well, we know, we covered last week how electric vehicle incentives have ended, subsidies have ended in China, resulting in a fall in demand, and you're seeing that directly reflected in lower lithium demand.
Yeah. There's neodymium, nickel. Nickel actually just regained its trend line, really, hasn't it?
Yeah.
After that violent rise. There's tin.
I find tin very interesting because this seems to me to show that actually semiconductor demand is falling again.
Yeah. It's ferrovanadium. And there's zinc. And moving on to precious metals, so a good week for precious metals. So gold up 5%, silver up 9%, although down 8.5% in the year still. Platinum up 5%, rhodium down 5%, palladium up 5%. So a bit of volatility down at the bottom of that table there. But notice how the only one that is actually ahead on the year is gold. And I noticed that gold is up today and it is heading back towards its February high. And it's not that far off the high that it achieved in April last year. So I think SVB has really unsettled the unsettled the gold market in a way that's positive for gold. So there we have gold. And silver. Platinum. Rhodium. Palladium.
Yeah, looking at the chart, there's a huge difference between gold, which is a store of value, and the industrial precious metals, which are just collapsing.
Yeah, there is indeed.
Okay, and on to rates. Thank you, Richard. So it was a big, big week in the rates market. So we're looking at the UK. We had falls across the curve and falls more at the short end than the long end. So the whole of the yield curve came down, but it flattened. In the periphery of the Eurozone, we also had falls across the board. So the market remains relaxed about the possibility for a Eurozone crisis. So this chart shows shift in the yield curve before and after the Silicon Valley bankruptcy. And you'll see in February, it was forecasting a near-term peak, which then after the non-farm payrolls and the hot inflation prints massively moved up, expecting yields of 5.5%. And then after Silicon Valley, the yield curve has shifted down, but not so much to revert to where it was in February. So yields are still higher than they were in February. Okay, so one of the reasons that the yield curve shifted as much as it did could well be because speculators were net short treasuries and then had to buy them back and were squeezed. Beware crowded trades. Now, what I find interesting about the UK is suddenly we've got a flat yield curve. So, which is weird, frankly. I just do not think the UK economy can survive long-term interest rates of the best part of 4%, given a year ago they were less than 2%. So a lot of debt will need to be refinanced at much higher rates, just suck demand out of the economy.
So Keith, I just like to chip in here. I agree with you that logic suggests that you're right. My only concern is that we are in such strange times where we've had such vast manipulation of the markets in a very general sense by central banks that relying on previous models is not a sure thing anymore. So that is my concern. And what happens if, rather than yields dropping because the economy is going into recession, they don't drop or they go up for other extraneous causes that have actually got nothing to do with the underlying economy, but have got to do with the financial bubbles that have been blown.
Yeah, confidence. No, I completely agree with that, Richard. I mean, the last week has shown you that these everything is highly uncertain and volatile.
Yeah.
So this is the UK 2-year, and you see it's come off, but you know, those are still high levels. We still have an inflation problem. Inflation in the UK is still 10%. This is the 10-year, again, off its highs, but still very high. 30-year, same. This is the US 10-year, again, down, but not by that much. The Fed needs to get inflation under control. German Bund yields, those haven't come down much at all. Reminder, the ECB raised rates by 50 basis points this week. Italian 10-year, same. Greek, actually surprisingly quiescent. So on to our view. And actually, I've changed my view on gold. I think gold probably does okay now. I think interest rates have peaked. We've got loads of uncertainty and stress in the financial system. I think gold would probably do well. And Richard has been ahead of me on that because you've been a buyer of gold for a while.
I have indeed, Keith, but timing is always difficult with these things, isn't it? I believe in the thesis for gold, but my timing has been bad. So I continue. You've had my recent caveat about bonds that intellectually it makes sense, but I worry about what's really going on in the guts of the financial system. I still believe that industrial commodities are a selective buy, despite the pretty dreadful, or maybe because of even now, the pretty dreadful numbers that we were looking at just now. But I think there is a secular shortage of many of these things.
Well, honestly, Richard, I think things are very, very uncertain now. And I think that whatever happens, we're going to have tightening credit conditions. Because even if the Fed and the central banks pump the banks full of money, they're going to be much more cautious about lending it out. And, they're now concerned about their solvency, not liquidity, and getting through this period. So I think you'd see banks reining in their horns and reducing their loans.
Yeah.
And frankly, Credit Suisse, watch this space.
And your view there will be that then becomes bad for industrial commodities.
Yes, bad for everyone. Yeah. And also, when I have this big long bond trade on, but, the OBR is forecast for UK deficit. They're predicated on the UK avoiding recession. If the UK goes into recession, then, the deficit explodes. And potentially there's loads of gilts issuance, etc. You could see long bonds not coming down as much as I'd hope.
What does that do to your view on bonds, Keith, which you still have as a buy here?
Yeah, I still have a buy, and I've still, I still have a lot of duration, but I haven't added to it because I think it's so uncertain that, basically the risk on the portfolio is as high as I would like it to be.
So I think, just briefly, my world view at the moment is that the world is awash with too much debt. To get rid of that debt, you have to have there has to be a significant contraction in the world economy. If there's a significant contraction in the world economy, governments can't afford to pay to service the debt, and the only way that the debt can be funded is by QE, and QE adds to the problem. And at some point, there has to be a discontinuity in the system to reset it. That is my world view. But when that happens, I don't know. Does it happen next week or does it happen in 25 years' time? I don't know.
I think our worldviews are very similar, but slightly different in that I completely agree with you that there's far too much debt and that it is unsustainable at these interest rates, and therefore something has to give. You either have to have a solvency crisis, which everyone's going to do their best to avoid, or you have to have lower interest rates and QE. And that is only possible if inflation comes under control. So banks need to, their number one priority has to be to get inflation under control, because if inflation is not under control, then you have QE. That if your QE adds to inflation, and that in itself causes higher yields. Basically, the central banks would lose control of the yield curve, and then the whole thing blows up.
I agree, Keith. Yeah.
So watch this space, but it's fragile. If they don't get inflation expectations under control, then you have a self-fulfilling prophecy disaster. So concluding comments. Well, all change. Volatility is back. Confidence is everything. If the market loses confidence in Credit Suisse and then the global banking system, then frankly, all bets are off. Over the coming weeks, we're just going to have to see what happens. All the indications are that the market's just lost confidence in Credit Suisse, and so there'll have to be a resolution of some kind. And depending on how that is handled, you'll see credit conditions, they can only tighten. I'd suspect the real world credit conditions are going to be tighter from now on, because banks, the lesson is they need to look after their solvency. Okay, Richard, how did you do this week?
Thank you, Keith. So I had a relatively decent week, obviously with the price of gold going up and silver. So I'm up 6.4% on the year now. And because the FTSE All-Share had a rather bad week, my relative performance has gyrated. But I sat on my hands all week, no purchases and no sales. And yeah, that's where I'm staying for the time being. I got a couple of charts. We've sort of covered this, but I came across these this morning from Gold Money. And this is a chart of European bank lending. It shows that since the great financial crisis, credit to private non-financial sectors by banks has slowly declined. And there's a comment that said, all bankers are now aware, this is basically after SVB, their business is increasingly being driven by fear of losses, of which there are three forms: a fall in the financial asset value, i.e., which is what led to SVB, the lending risk, which we've talked about, and counterparty risk in the clearing system, which we've seen with the increase in the facility offered by overnight facility being offered by the Fed and the massive take-up that's been caused. So the banking system has serious issues. European banking system hasn't been lending to the economy for the last 12 years. And then this is just a graph of bank credit for financial speculation in US markets, which is falling sharply. And that in itself should mean that the valuation of financial assets should start to fall, or would be falling, because there is less money available for speculation on margin. Do you think, Keith?
Well, it hasn't happened this week, Richard.
No.
Because actually, one chart we haven't included this week, but I'll include next week, is the net liquidity chart. And that will have absolutely shot up because the Fed's balance sheet has shot up. And, the correlation between the NASDAQ and net liquidity shouldn't work, but it really seems to.
You're quite right. Yeah, that'd be really interesting to see that. So effectively, I'm not at all confident in the financial system at the moment, and I'm keeping a lot of my assets sort of as well away from it as I can. How about you, Keith? How was your week?
Thank you, Richard. I had a good week, but not an overwhelmingly good week, frankly. So long bond yields fell, but they didn't fall as much as I might have hoped. And so that takes me back to flat on the year, having been down. So I had a very good week versus the FTSE, but massively underperforming you. And flat is okay, but it's not, great. I mean, this trade has yet to really start working. And for it to start working, inflation needs to come down, and the central banks need to hold their nerve and continue raising interest rates. Now, the ECB did hold its nerve this week. Let's see what the Fed and the Bank of England do next week. So previously, I said I wouldn't add to this trade, and I haven't. What I have done is I sold my US Treasury 20-year plus ETF earlier this week when it spiked, and I put it into the 2068 gilt. So although I didn't add to my exposure, I closed out the US and I put it into the UK, where there's no capital gains tax. And so that is a more efficient way of doing my bet. It also added some duration, but I haven't added to my net exposure. Now, when I get a chance, and the weeklies are so full at the moment, I haven't had a chance to really explain this properly, but I've thought a lot about when to enter the long bond trade. Now, obviously, I've entered it way too fast, and we did a My Worst Trade last week, in which we talked about having selling discipline and having a selling strategy. It doesn't really matter what it is, because none of them perfect, but you have to have one. You have to stick to it. Now, What I've done in the long bonds trade is I've been impetuous, I've been too early, and I didn't really have a trigger to enter the trade. Now, I've looked at it, and what I've decided to do was to enter the trade when the 1-year yield falls below Fed funds, i.e., when the market is expecting interest rates to start falling. Well, this week it triggered. So the market is now expecting 1-year yields to be below the Fed fund rate. But frankly, things are so volatile, it could flip back next week. So I'm not doing that. Actually, I'm going to sit on my hands and see how the next few weeks develop. But we're getting closer to the point I should have entered the trade. Not yet. Okay, so this is the 2068 gilt. So 1 year ago, over a year ago, it peaked at 300. Okay, I entered way too soon. I entered about 106. Okay, but the range is absolutely enormous. And when the economy slows, inflation comes down, I fully expect this to go back towards 150. So I still believe in this trade. I still think there are tax-free gains to be made. And this could be a good entry point, but there's a huge amount of uncertainty, and these are very risky assets. This is 2071, again, off from its lows, but, still not back to anywhere near where it was in early December. Okay, that is it. Thank you for watching. It has been an extraordinary week in the markets, and actually the data bears very close attention at the moment. The whole of the world economy is up in the air. So tune in next week for another update, and let's hope next week is not as exciting as this one. But in the meantime, it is thank you for watching. Please can you press like and subscribe to the channel, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.